As we come into the end of the year, it's a great time to take a look and see if you should take advantage of tax loss harvesting. And little red flag, here we are at the end of 2025. This might be the last year you can do traditional tax loss harvesting. There is a proposal in the Senate to implement what's called the wash sale rule. Won't get into it, but it would pretty much prevent you from doing tax loss harvesting next year. So take a look at doing it this year. First of all, what is tax loss harvesting? Well, each year you trade and hopefully you have lots of winners, but you may have some investments, some assets that have gone down. And the idea is while it's down, let's sell it, recognize that loss. That loss then offsets other gains in the year so that I can reduce my taxes. This is a powerful idea. There's a couple gotchas around that. Now, the idea is if I sell a loser, if you think that asset is really a great asset, even though it's upside down in value, and you want to hold on to it, then you can buy it right back and it can still go back up. So you're not really giving up the position as much as changing your cost basis on it. Now, the wash sale rule, which will probably go into effect next year, prevents you from buying it back within 30 days of the sale. Otherwise, it's a harsh penalty. Let's talk about this year. When should you do tax loss harvesting? Do you do it on all your losers? The answer is no. You only want to recognize as much loss as you are having gains that year. You're trying to bring your taxes down. Now, particularly, the types of gains you want to eliminate are your short-term gains because they're taxed at a much higher rate. Average person might be experiencing 30 to 40% tax rate when you start to include state taxes, whereas long-term rates are down in the 20% range. So you want to use that. Now, one of the concerns that people have is tax loss harvesting fundamentally a smart financial strategy or just a symptom of a broken tax system trying to patch over volatility? Well, the tax loss harvesting is a simple investment technique that anyone would do. Why hold on to losers? They're only going to go further down. You must sell them and recognize them and to reduce your taxes. It's only smart investing. Do you have to harvest losses each year to truly reduce your tax burden, or aren't you just kicking the can down the road? This is a concern. Let me give you an example. Let's say we bought a investment at $10 a coin, and then that investment went down to a rate of $2 per coin. If you sold it, then you would recognize an $8 per coin loss, which might be, with a lot of coins, that'd be significant. But you've also reset the cost basis from being $10 a coin to $2 a coin. Now, in the following year, let's say the price goes up to $20, and now you want to sell. You have a couple problems. One is because you've rebought it more recently, you might be looking at a short-term sale rather than a long-term capital gains recognition. Short-term is at a higher tax rate. Short-term is if you've only held that particular investment for a year or less. Secondly, the cost basis now is much lower, so the amount of gain that you're going to be taxed on is much higher. Consider this. If you'd kept it at 10, your gain would have been only another $10 per coin. But because you did tax loss harvesting, you're down at $2 a coin. Now your gain is $18, much higher and possibly short term. So you need to not really do tax loss harvesting. If you're going to buy the position back and you expect to sell it in a short time frame, that's probably not a good coin for tax loss harvesting. Some people have wondered if harvesting actually achieves long-term growth. We've done a lot of experimentation on this and modeling, and our simple observation is it's far better to reduce your taxes in the current year and let next year take care of itself. Anything you can do to reduce your taxes this year is good. We have no control over what's going to happen next year, so you might as well minimize your taxes in the current year. That's the best strategy, the best way to look at tax planning. Crypto currently avoids the wash sale rule, but does that create an unfair advantage that the IRS will eventually clamp down on? There's a bill in Congress by Cynthia Loomis called the Digital Asset Tax Act, and they're proposing reinstalling the wash sale rule. Here's what happens with a wash sale rule. If you buy an asset back 30 days before or after you sell it, then you're denied claiming that loss. So in our little example, we have a coin that's bought at $10 and you sell it at $2 and then you buy it right back, you're denied that $8 loss, which defeats the entire purpose of tax loss harvesting. How does the IRS know that this happens? They know this happens because they'll get a 1099 DA form that goes from your exchange to the IRS, which reports when a wash sale is happening. So that's how they know it. The wash sale rule has often been called a tax on being stupid, basically a foolish novice investors. What the professionals do is if they want to harvest the loss and they want to keep that position, they simply buy that position back on a different brokerage because the brokerages don't coordinate when they send information to the IRS to capture wash sale related activities. And the IRS doesn't do a specific search on that either. Once it happens to you and you're upset and you realize how to avoid it in the future, that's why it's a stupid tax. It's a tax on being stupid. Once you've learned the lesson, you know the game, off you go. This is a big issue for crypto investors. Which crypto investors should really watch out if the wash sale rule goes into law? It would be those investors that are high frequency traders going in and out of certain coins, because you're going to likely sell a coin and buy it back within that 30-day window. And that would trigger a wash sale rule application, which would deny you the loss. That would be the issue. And of course, you just want to spread that trading out over several exchanges so that no one exchange would report the wash sale. If the wash sale rule is eventually applied, should it treat wallets and distributed exchanges the same way as brokers? Well, first of all, the wash sale rule only applies to transactions where you're actually unloading ownership of it. So pretty much this would be centralized exchanges. Decentralized exchanges, yes, you're doing it, but decentralized exchanges do not have a 1099 DA reporting obligation. So there'll be no disclosure of that to the IRS automatically. The centralized exchanges like Robinhood, Coinbase, Kraken will have to report these events when they recognize it's happening. And that's the only way pretty much the IRS will know that it's going down. That is to say, a wash sale rule event has occurred and that a loss needs to be denied. Some people have asked, what is the biggest blind spot traders have right now about the wash sale rules and what will come back to bite them later? Well, there's two blind spots. One is when you do a wash sale, it changes your cost basis and it pushes your acquisition date closer to the future. So it's much more likely that when you do sell it, you'll have a short-term gain at a higher tax rate than had it been a long-term gain. So if you have long-term assets that you want to roll over as losses, be certain that you don't want to buy it back in the near future. Other blind spot would just simply be high frequency traders coming in and out of those positions. They would be up for a tremendous surprise if they do that activity on a centralized exchange that's going to report a 1099 DA. I wanted to say thank you for watching the Clinton Donnelly Show. Every week, we bring you the insight you need to stay ahead of the IRS, understand your crypto taxes, and protect what you've built. This is information you simply won't hear anywhere else. Not from influencers, not from exchanges, and not from the IRS itself. My goal is simple, to give you the clarity and the confidence to trade, invest, and sleep well at night. That's what drives me, and it's why CryptoTaxAudit exists, to defend crypto traders and keep our clients safe before anything becomes a problem. If you find these conversations valuable, hit subscribe so you don't miss what's coming next. Only a quarter of our viewers are subscribed, and every week I share something that can help you avoid mistakes, protect your assets, or save thousands at tax time.